Hey, what's up guys? Welcome back to Avoiding Broke with me, Jermaine. Today, I'm going to explain to you in the very best way that I can why it's so important that so many of you young people start your investing journey early. Sometimes as we go through, we don't necessarily get a lot of information about any type of investing in school whatsoever. You'll know that financial education is not on your curriculums, and I know you may be wondering, why should I start investing? Why is it so important? And what is critical about investing to my long-term future? So right now, let's break it down with one quick diagram. So guys, if you firstly just assume that you've got somebody who is going to take the role of an employee, we're going to call them E. And this is somebody who we're going to say does not have any interest in going on an investing journey. They're simply happy to turn up to work, punch the card, and that's pretty much the extent of what they're willing to do. Yes, they may save, but really and truly, there's nothing too creative about what they do. Over time, where they find themselves quite often is they may, if they're fortunate, have a property that they own. This is by the time that they retire. They may own a property. They may, if they're lucky, have a single source of income in terms of a pension, and they may have a little bit of savings. Typically, when you look back at your life, and you know, a lot of people will say start work between 16 and 21, 16 to 21, and they'll be going through till their mid-60s, and by the time some of you come to retire, it may well be in their 70s. So normally what we're talking about is kind of 50 years of commitment in order to maybe have a property, a single source of income, and a little bit of savings. This is what often happens if you take the non-investing journey. But let's just contrast it with the life of an investor. And the investor we're going to call I. Well, let's just put inv. Make it a little bit clearer. Well, an investor does things ever so slightly differently. So an investor may well have their own property, which is fantastic. They've got their home that they live in, which is excellent. But on top of that property, they may well have several others that they can actually let out. And the beauty of these other properties is they give them a source of income in retirement. An investor may also have previously worked for a company, just like the employee. So the investor, they may have this other pot of money in the pension. So I'm just going to put the $ here, and we're just going to put pen just to make it really clear. A pot of money is from pen. And up here, let's just adjust. We'll put the pot of money from property. Now, some of you may be aware that investors typically also like to invest in stock markets. When you're actually diversifying, you try and look at different places to put your money. So as an investor, you may also have some money in a stock market. And what I'm going to draw here is a laptop, and I'm just going to assume there's trading happening. That particular stock market wealth, if markets perform as they hopefully will do, and obviously past performance is no guarantee of future results, but that stock market performance is hopefully going to give you another flow of money. And we're going to call that the STK, stock performance, or portfolio. We can call it portfolio performance because it's not just stocks, you can have bonds in there as well. Investors may also love to go and take on some commodities. So right now you hear a lot of people going for a bit of gold. So you may well have some gold bars. Right, I'm going to put the gold here. Gold is often used as what you call a hedge instrument, or something to kind of give you a little bit of insurance. But the reality is the value of your gold can go up, and that in itself can give you even more money. So we're going to put gold here. We're just going to assume gold. As an investor, you may also have, blimey, we're going through a bit of everything. You may also have a bit of Bitcoin. We're going to put a dollar here and we're just going to put bit. You may also own a beautiful piece of art which you've invested in. We're going to put a nice bit of artwork here. And if you needed to, you could sell that and that's going to have some value. And you may also have your own personal savings pot. So we're going to draw here, and just like before, we've got save. Guys, just compare these two worlds. What a marked difference, right? On the one hand, we've got our stock employment without any investing, which has maybe given us our own property, it's maybe given us a pension, and it's given us a savings pot, which is fine. On the other hand, if you choose to get a little bit smarter and more creative with what you choose to do, not only can you have your own property, but you may invest in others. You can have a pension pot as well by virtue of being an employee, or you can invest in your own pension, a SIP, a self-invested personal pension, where you could be a company owner but choose to put money into a pension. There are many tax advantages to doing that. You can be involved in the stock market. You can own commodities. You can own alternative currency, so like cryptocurrency. You can own artwork. You can also have a savings pot. And what all of these things contribute to do, and this is the bit that I really love, when you bring all of these different things together, the benefit of being an investor, is when you look at this whole equation up here, whereby you work for these kind of 50 years, and if you're lucky, you get to relax for kind of 15 or 20. Over here, you don't have to work for as many years because you've got more income flows going. So over here, like we say, the maths is you work for 50, work equals 50, and your chill equals maybe 20, assuming you're going to live to about 90 years old. Over here, if you build your portfolio sensibly, you're maybe going to work for 25, and your chill could maybe, if you're lucky, look something more like 45. You're playing with the same 70 years, but you're reconfiguring how much work you need to put in for a greater amount of chill time. And what you often find here is when you're 70 and you can actually draw your pension, you're physically often not going to be as fit as you once were, so you're not going to necessarily get the same value. Whereas here, if you start work, even just assume post-university, and you work for even 29 years, you can achieve your retirement at 50. And you may still have 41 years to kind of play around with, or 40 years, to play around with, just assuming the same kind of retirement age. And guys, that's what the benefit of being the investor. The benefit is you understand the long game, and you put a great premium on being able to play by your own rules later on in life. So you grind in the short term, you hustle in the short term, and then later on in life now, you're able to flip the work and chill equation on its head. Maybe we should even rename this. This whole thing that we've just been talking about, this is now going to be called the work-chill equation. And what I would encourage everybody who is listening and watching this video, you come up with your own view about what you want your work-chill equation to look like. If you want to have a lot of years of chill, then you need to get really smart with how you're working, what you do, how much time you put in, and what you're going to pull out from it. And if you manage to get the work-chill equation right, you can set yourself up for a far more fulfilling life than you could ever imagine. Alright guys, if you've liked this video and found the content valuable, smash the like, smash subscribe, and tune in for more videos. I'm looking forward to bringing them to you. Take care guys, have an awesome day. Bye bye.